In this video, I'm going to shoot it straight to you. If you want to be lied to, watch a different video. Hell, get off YouTube. If you don't want to make money, click off this video. Because if what I think could happen, or if the probability of what could happen continues to rise, the probability that you make a crap ton of money is also rising. And I'll explain that here in this video. But the only way you can do that is if you are prepared, okay? It's kind of like having fire insurance or flood insurance. Probably the best analogy to use. You hope, at least most of you probably hope, you don't have to use it. That it's something you pay every month, even if your house is paid off, especially if your house is paid off. And, well, in the rare event that you need it, you make a lot of money, or at least save a lot of money, okay? It's kind of like that instance. But instead of, let's say, out of 10, right? You could use years in the same analogy as home insurance on a house. You say your risk any given year of a fire is 1 out of 10. Well, in terms of the markets right now, maybe it's a 4 or 5 out of 10. Maybe it doesn't happen. Maybe you're not saved by fire insurance. But in the event that you do have a fire and your house burns down, well, you're going to want fire insurance. Okay, now that the weird analogy is out of the way, what I'm actually referencing here is a major stock market crash. Now, I actually heard this on CNBC, and this individual said it's kind of like the Palisades fire, not to bring up a tragic crisis in this way, but that's what he did on CNBC. So I'm going to use the same analogy because I think it works. What you're seeing right now with the economy weakening, with recession odds rising, is and Doge really trying to right-size government. It's like pre-burning, right? If they had done that in the Palisades region, you would have never gotten this disaster that you got a couple months ago with the whole thing burning down. You're going through a controlled burn stage now. Yeah, sure. Could we have a recession? Of course. Is it going to be a really bad one? Probably not. Because again, you're getting ahead of a problem. One of the things that I was seriously starting to fear before the election was, for really my kids' sake, I mean, I'll do fine because I'm in markets. You'll do fine because you're in markets, presumably. But 10, 15, 20 years from now, at the rate in which we were going at with debt and all of that, we were going to be in a really, really bad situation, like a depression, maybe worse than the depression. 10, 15, 20 years from now, as probably the world at that point says, yeah, we don't want U.S. debt anymore. And, well, good luck getting a house, a car, or selling anything, doing anything, okay? It was a financial disaster in the making. It would actually be healthy to get a little bit of a recession here. And what we seen on Friday, Donald Trump at, 4:19 p.m., said that he was open to making a deal about auto tariffs. And the stock market proceeded to sell off in after hours on that. Because, as I talked about in the last video, the damage is done. The damage is done to the economy. The GDP for Q1 2025 is tracking negative 0.5%, negative 0.5%, excluding gold. If you add gold imports to that, you're actually down almost 3% for Q1 GDP. The damage is done. I think that's kind of the same for the markets as well, to a certain extent. Now, anything can change. Data can be volatile. We get that. This upcoming week, we're going to get a lot of new information. Now, unfortunately, I think a lot of people are going to focus on Reciprocal Tariff Day on April 2nd. And I don't think that really matters anymore. It's kind of like the Fed, right? At some points, the Fed really matters to markets. It's the big catalyst for markets. Other times, markets don't really care about the Fed. It's earnings, it's AI, it's whatever else is going on at the time. Well, I think you're leaving the stage of tariffs really mattering for markets. That it's the big catalyst. It's not anymore. That's clear. Okay. Unless, obviously, all tariffs were dropped, trade war's over, and then kind of at that point, like, why? It might be one of those situations like if the Fed came out on Sunday and cut rates, well, that's great. The Fed cut rates, but why? Do we have a bigger economic problem? That would kind of be the same message I think we would get if the trade war was dropped. Nonetheless, neither here or there. I don't think tariffs really matter to the markets anymore. I think it's all about the economy and where things are headed, economically speaking. And, well, it's just you're getting beaten down left and right. The economic data has been bad, to say the least. Personal spending was bad on Friday. Basically, everything has been bad recently. And we have a lot of data coming up in this upcoming week. Now, I understand most of you guys are Tesla investors, and I think that's a fantastic decision long term. Although I think in the near term, there might be more risk than some people think. Even next week on April 2nd, I think Tesla is going to explode higher that day. Because I think we're going to get a bad delivery number. But I think Tesla is going to indicate that that's not going to continue. That production is back. It's ramping for Q2. That Q2 is going to be better than Q1. And that's really all you need to see, right? Is some validation that things are going to get better from here, not worse. Wall Street doesn't care about what already happened. They care about what's coming next. That's why you can kill earnings, like completely blow out your earnings. And this goes for any company. Like EPS beat, margins beat, everything beats. But if you give a weak guidance for what's ahead, doesn't matter. Stock's still going to sell off, right? That's kind of the situation I think we're in for April, right? For April 2nd for Tesla. You're going to get a bad delivery number, but good guidance, essentially, for where things are headed for Tesla. And no, this is not Tesla's earnings, but I think there will be a statement coming out from Tesla that production is back. We had a slowdown of production, and that's why deliveries were slow. But production's back, things are fine. And that's why I think April 2nd is actually going to be a really good day for Tesla. But I don't think it's going to really be a big catalyst, especially for the upside like some people think. We'll see. Obviously, we'll see that could definitely change. But that's kind of where my thoughts are at around that. Okay. It's much more important what's happening to the economy right now. And I think Wall Street's saying the damage is done. Like, whether it's a small or large tariff, it really doesn't even matter anymore. Now, with that said, the big catalyst for markets are going to be the economic data. Soft data has been bad. I don't think that's a huge deal anymore. Like on Monday, Chicago PMIs, Dallas Fed Manufacturing Index, not a big deal. Yeah, can it move markets? Of course, but I don't think it's, again, a big deal. On Tuesday, you get ISM manufacturing PMIs. Again, that's soft data, not a big deal. JOLTS job openings, hard data. You're expecting 7.68 million. That's really not much of a change from January's 7.74 million. If you see this number come down a lot, that's a negative sign for the economy. If it goes up, that's potentially a positive sign. You have JOLTS job quits, you have manufacturing new orders, prices paid, RCM TIPP economic optimism index. You're actually expecting that will get a little bit better. So that could be important because sentiment tends to drive reality, right? If people feel bad about the economy, they tend to spend less. and that tends to actually show up in hard data later. So that could get interesting. The ADP employment change is expecting, there's an estimate here for 120,000. There's another forecast here for 60,000. I mean, your guess is as good as mine. Markets don't react to that all too much. On Thursday, you get ISM Services PMI. Even though this is soft data as well, it's a little bit obviously more important than manufacturing PMIs. So I think markets will react to that on Thursday. On Friday is your big day. You have non-farm payrolls expecting anywhere from 128,000 to 80,000. Obviously, the lower, the worse the markets are going to take it, right? So, coming in lower than even 80,000, yeah, that's bad. Unemployment rate expected to rise from 4.1% to 4.2%. And then you also get a speech from Jerome Powell at 10:25 in the morning on Friday. So it's kind of like last week, right? Nothing really mattered until Friday. And we talked about that from last weekend until Friday. That it didn't even matter if markets went higher, lower, blah, blah, blah. Personal spending data that we got on Friday was really going to be the big catalyst. And we've seen that. I mean, markets moved down a little bit last week at the beginning of the week. Beginning of the week, you actually, I believe, went higher for the first 2 days or so. Yeah, Monday was up 1.8%. Tuesday was up another 1/4%. And then Wednesday, Thursday, Friday, not so great. But really, Friday was a huge down day. Down almost 2.5% across the board because the data was so important. It's kind of the same for this upcoming week. I don't think Wednesday matters all too much in terms of reciprocal tariffs. I think it really comes down to the data that we're going to get on Friday. Even if the reciprocal tariffs are small. The question is that enough to push us into a recession? And I think at this point, the markets are saying no matter what happens, we could be going into a recession. Again, Q1 GDP is negative 0.5%. I don't think this is necessarily rocket science. I'm just pointing this out before Wall Street realizes and starts talking about this. I'm just early to this. The markets don't care about tariffs anymore. It's all about the economy. Okay? And also to a I think lesser extent, believe it or not, inflation. And I say lesser extent because, look at TLT on Friday. TLT did very well. Even though the data was pretty stagflationary. So I really think it's all about what happens to the economy from here. In that regard, I'm not super enthusiastic. Now, could things get better? Of course. But I think there's a much higher probability than normal. Again, maybe a 4 out of 5 or 4 or 5 out of 10, right? That the house is going to burn down. I think that's kind of where we are now, whereas in a normal year, maybe it's a 1 or 2. So the risks are elevated. And there's 2 people watching this video. There's one person watching this video that's going to comment down below in the comment section, have something nasty to say that doesn't understand economics or the stock market on a deep enough level. And they're going to be mad. Maybe they're all in on this market, margined to the tits, all of that. And they're going to say, you're wrong. Tariffs matter, blah, 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 all of that. There's going to be the other guy that's maybe in cash besides Tesla, maybe a little bit less allocated to certain riskier areas of the markets that are ready for this, that are going to love this if markets continue to fall. Because the fact of the matter is, if you want to get rich, if you want to make a lot of money in markets, the biggest and best opportunity to do that is during a recession, is during a crash in markets. So the lower markets fall from here, the better off you will be if you prepare for this. Again, like fire insurance. You should probably always have it because if you need it, and you don't have it, you're probably screwed. But if you have it and actually need it, then you're probably good, right? That's kind of where we are now. And I think the lower we fall on markets, the obviously more incrementally exposed to markets you want to be. But I think there's massive downside risk in markets here. I mean, Wall Street's expecting $260, $270 of EPS this year. If we go into a recession, we get the average 15% decline in earnings, which given the tariff impact could be realistic. You're looking at about $201 of EPS on the SPY for the SPY. And give that an 18 times multiple, which is generous during recessions. And you're looking at 361 on the SPY. Well, that's not quite your 2022 lows. Your 2022 lows were 336. But 361 from here would be 35% downside. I don't know about you guys, but with that kind of downside, I would want to be prepared for that. And I'm just telling you this before everyone else is talking about it. Okay, before it's mainstream, before it's priced into markets, if you will. So what does this mean? I think you want to be in zero margin debt at all. Zero. Zilch. Okay? Because what is going to happen is if markets do fall a lot, whether you're in stocks or not, you're going to be able to margin. So margin is a great thing. It can also be the worst thing. Margin is a great thing if you go into a recession, asset prices get devalued on a massive scale, and you're able to buy those assets near the bottom of the market. That's where margin helps you. That's where margin is great. Now, margin is dangerous because you never truly know when the bottom is in until the bottom is in. And it's hindsight, right? So you got to be careful when you actually start to margin. But it can be a very useful tool. Now, obviously, cash is king. If you have cash, that's great. I just mean if you're fully invested in markets today, as long as you're not in margin today, you can use that margin if you wanted to when markets are down. And obviously, I'm not a financial advisor. I'm not a financial planner. Contact one if you have any questions. I am not specifically saying to use margin. Let's be clear. If you use margin, you'll probably lose all of your money. Okay? Especially if you don't know what you're doing. Let's be very, very crystal clear on that. I have no margin debt today. Zero. Zilch. Okay? And I don't plan to use margin until markets are down at least another 20% from here. Maybe 15% is when I would start dabbling with that, depending on what's going on with the economy. Because the fact of the matter is, I don't think this is 08 or 09 again. I don't think it's going to take 4 years to recover after this recession, which we probably are going to get. I think it could be a 6 to 12 month recovery. Not a V-shaped recovery, but a relatively fast recovery. And at that point, inflation is going to be killed. Okay? And the economy will be normalizing and hopefully getting back to some growth. So I don't think it's going to be a long-term disaster for markets. But if you are able to prepare right now, you are going to walk away very rich from what comes next. I mean, we're still near the top, guys. Like, you're still in the early innings of this. If we fall another 35% and you're able to capitalize on that, you're going to make a crap ton of money. Now, Tesla's down 50% from all-time highs. I think Tesla's priced in a lot of that bad news. Okay? And I think that's why some big tech stocks sold off more than Tesla. Meta sold off more than Tesla. Amazon sold off more than Tesla. Google sold off more than Tesla. Microsoft sold off around the same as Tesla. So Tesla is actually doing well, right? Tesla, relatively speaking, did very well on Friday. Now, April 2nd, big day for Tesla. Again, it's not really about the deliveries. It's about the forward-looking kind of guidance or statements, if you will. But if we go into a recession, Tesla's going to fall further. Tesla could fall to the 150s. Tesla could fall to 100. My worst case scenario for Tesla is around $80, but I think 100's like a realistic worst case scenario. If you get a chance to buy Tesla at $100 again, and I could somehow look into the crystal ball and say, hey, Tesla's going to be $100 by July. Wouldn't you want to prepare for that? Wouldn't you want to save as much money as possible and get ready for that? Now, again, a lot of the time, the risk is not as high as it is today. The risk is way higher than normal of a larger market decline. And that's why I'm making this video. It's not an average economy, average market. No, this is a pre-recession market for sure. And maybe recession economy already, at least based on the data that we're getting. So, things are going to change. There's obviously going to be new data that comes out, and markets are going to, flip-flop back and forth maybe a couple of times. But I do think we probably fall further in markets. And again, you want to be able to prepare for that. Okay. And I mean, these charts just look where we are now looks so similar to 2022. It's actually insane. Right? So if things are correct, you're going to come down, hit another brief low, relief rally, and then really get destroyed in the early summer. Who knows? Obviously, I can't pinpoint it like that. But bottom line is, if you are preparing right now, you're going to be in a really good situation. Preparing means getting out of margin, getting out of recession risky stocks, saving as much cash as possible, while also staying allocated in markets to the extent in which you're comfortable with. I like Tesla here because it's down so much, and that's how I would want to be exposed to markets. Because, for an example, if the S&P rallies 10% from here, Tesla could rally like 50%. So Tesla gives you a lot more of that beta to the upside, but is already priced in a lot of that downside. That bad news has already been heavily discounted in Tesla. So that's kind of what I'm doing right now. Staying allocated, raising as much cash as possible. I'm not putting any new money to work right now, though. And I think that's important. I'm not so eager to go out and buy these dips when you may get a much better deal over the next couple of months. And the beautiful thing about this is I'm giving you a heads up. I'm telling you what could happen. Not a guarantee, but what could happen. I mean, I think that's the most valuable thing you could possibly have right now. Now, whether it happens or not, obviously, different question. But if it does, you're going to be very thankful that you watched this video and you were prepared for it. So maybe that's half preparing now. It's like maybe the world gets destroyed because of a nuclear apocalypse, right? Or maybe it's zombies or whatever the hell else it is. Well, maybe it's not a terrible idea to have a bag ready to go. You got some food, you got some medicine, you got a machete, a gun, whatever it is, in a bag ready to go in case shit were to hit the fan on any random Saturday at 4 p.m. Who knows? Is it time to build a bunker? Depends who you ask. Maybe it's not time to build a bunker, but maybe it's time to prepare for the, the worst of possible outcomes. That's kind of what I'm trying to say here. Maybe I wouldn't go out and short the markets like crazy. Maybe it's not time, if that's the bunker, right? Maybe it's not time to go out and put all of your portfolio into shorting markets, but maybe it's time to prepare for what could happen. So that's kind of the way that I'm looking at things. This week is going to be a crazy week. It's going to be huge for really solidifying. Do we have a weakening labor market? I think the labor market, if the labor market goes from here, you are, you're going into a recession. That's a big question though. I don't know. So let me know what you guys think down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.